There is a cost to share buying that's even more horrid than stamp duty, capital gains tax. Governments really don't like it when we are successful, so to put a stop to you making too much money, you have to pay taxes on share trading profits. For the tax year 2005 to 6, you are allowed to make up to £8,500 in profit. After that you have to pay tax. When I say profit, that is the net profit, all the profits on shares sold minus all the losses on shares sold. Of course, most new entrants to the market will be doing well to make £8,500 in a year, so maybe it's not something to worry about, but it could easily affect you in a bull market. What's even worse is that it is very complex to work out what you owe the taxman. You must keep a record of all your transactions. Luckily you will find your friendly broker will have kept them all for you, and you should be able to access them on their website using the History function. Giving general tax advice is always difficult, because everyone's tax situation is different. However, some quick tips to bear in mind. 1. If you hold on to shares for a few years, you may benefit from taper relief, where you pay a bit less tax. 2. Alternative investment market, AIM, shares only attract a 10% tax rate. 3. You can offset profits in a current year by selling shares bought in previous years at a loss. But as a rule of thumb, once you've made a profit of more than £8,500 per year, you face paying capital gains tax. There is a way to avoid tax. Not sticking all your profits in cash and putting it under the mattress and hoping the taxman doesn't find it. It's called ISA. Stands for Individual Savings Account. I know, you've seen ISAs advertised in papers, and hardly anyone has any idea what the point of them is. Well, thanks to recent government action, most of the tax benefits of ISAs have been wiped away, but the big benefit is that there is no capital gains tax to be paid. Currently, you're allowed to put £7,000 in an ISA every tax year. You might well say, what's the point? You can only put a small amount in, so surely capital gains tax will never be a problem. Wrong. I have saved thousands upon thousands of pound taxes that I would otherwise have had to pay if I hadn't put all my share money into ISAs, and PEPs as they used to be called. As the years go on, and you build your portfolios, the ISA tax advantage becomes more and more apparent. One for example. Let's say you have a few good years and build up £150,000 of capital inside your ISAs. All tax-free. Now say you have a very good year and turn that £150,000 into £250,000. That's a profit of £100,000. Outside an ISA, that profit could cost a huge £36,800 in capital gains tax. 2. Say you put in £7,000 and you strike lucky, you bought a penny share that trebled. You sell and you now have £21,000, a profit of £14,000. Inside the ISA, no tax. Outside, your profit will be taxed at £2,400. Nearly all brokers will manage a self-select ISA in conjunction with shares bought outside. It is worth checking to see if they make any standing charges to look after your ISA. Most do. Expect to pay around £15 a quarter. There is no maximum amount you can build in your ISA. One chap who writes for the Financial Times has managed to build his ISA fund to over £1 million. Withdrawal from ISAs can be made anytime, but once cash is taken out, it cannot be replaced except with your annual allowance. Tip: use your ISA allowance every year.